It's now time to join Tony Zhang from OptionPlay with a rapid fire session. Tony, the floor is yours.
Thank you so much, Michelle. And thank you so much, everyone, for taking the time out here this afternoon and joining us. And today, what I'm going to do is something quite different than what we've done during the options education days. What I'm going to do is do a rapid fire session. This is going to be really fun for everyone because as options traders, we need to have a directional view as to where we are, as to the products that we want to trade. So it's important that when we're trading the markets, that we have a solid understanding as to the directional view of a stock or ETF that we are trading. So today, what I want to do is I want to go through a fairly large number of symbols in a fairly short amount of time. And these are symbols that you as viewers and attendees have submitted ahead of time. We have taken the time to see which symbols were most popular. And now what I'm going to do is a rapid fire session where I look at symbols both on a technical and fundamental basis and break it down as to how I view the directional view and how I analyze each specific symbol to give you a better sense for a template that you can use to understand what are the best practices around looking at a chart and also looking at fundamentals and valuations to help you make the decision as to whether you might be bullish or bearish on a specific symbol. So let's go ahead and get started. But before I do, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So what we'll do is we'll start off with the major market overview. First, we'll take a look at the high level TSX 60 index first. Then we'll take a look at the sector rotation model to see within the sectors, where do we see some strength, where do we see some weakness, so that as we're looking at specific symbols, we want to understand that for bullish and bearish sessions. Then we'll do our rapid fire session, like I said, where we take the symbols that you guys have submitted ahead of time, and we're going to take a look at both the technical and the fundamental picture of about, I think, 13 or 14 different stocks in a fairly quick succession. Talk a little bit about option strategies that may be suitable on these types of names before I try to open this up for Q&A if we have a few minutes at the very end. But my name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And some of you may know me as the host on Options Action every single Friday at 5:30 p.m. on CNBC. And what I'm going to be doing today is very similar to what we do on CNBC, where we take a specific symbol, we talk through the fundamentals, we talk through the technicals and how the chart currently looks, and most importantly, we show you how to leverage options to take a directional view. And the key here is to use options to limit your risk. So we're going to try to cover as many of these things as possible and give you a better sense for how a strategist like myself would analyze and evaluate a specific stock or ETF and decide how to go about trading it from an options perspective. So we'll start off with the broader markets with XIU, the TSX 60 index, which is very much in a very strong uptrend if we look at it both on a weekly chart, which is what I have on the left-hand side, and the daily chart, which is what I have on the right-hand side. And it's very much in a straight line to the upside. And whenever you have a straight line like this to the upside, you really want to trade the range. You want to be aware of the range, and when it's near the bottom of the range, those are opportunities to establish a long position. And as you get towards the top of the range, that's when you want to lighten up your long positions. When you have such a strong uptrend, generally speaking, shorting is not a particularly fruitful endeavor. Shorts usually last very short amount of time, many times just a few trading sessions, and they typically tend to be very shallow. So unless you're extremely tactical on timing and being able to get in and out of those trades very quickly, shorts have been largely an unprofitable trade. So many times it's about finding where is their strength, where is their rotation within specific sectors, and then take a look at the specific names within those sectors. And for that, we typically look at sector rotation to help us understand this. Now, this is a sector rotation chart. And for those of you, this might be the first time you've seen something like this, but what it measures is both momentum and relative strength of the 9 sectors in Canada and where they currently are in relation to each other. And the chart may at first look confusing to investors, but they largely move in a circle. And basically, depending on which direction it's heading in within that circle, gives you a better understanding as to whether the sector is currently improving, whether it's leading in terms of the strongest category, whether it's lagging behind, or if it's starting to weaken. So if we look at the current sector rotation model right now, what you have is you have healthcare, technology, and utilities in the improving towards leading categories. So as markets, as I showed you here before, XIU is near the top of the range, this tends to lead towards a bit of a pullback towards the bottom of the range. And what you're looking for is perhaps some weakness in the weaker sectors. Those are the ones that if you are going to short, have the highest probability of moving lower, quicker, and faster. And then as you reach toward the bottom of this channel, you want to look for strong stocks and strong sectors that are likely going to bounce faster than the other sectors. So the sector rotation model is extremely important in helping us identify which sectors are outperforming the other sectors and which sectors have stronger momentum. So right now we have utilities, technology, and healthcare. On the upside, you have energy moving and weakening. You have materials that's weakening, and you have financial services that are weakening, and you have consumer discretionary starting to improve, but not quite there yet. You have consumer staples that has been leading, but is starting to weaken. And then you have industrials that really hasn't moved much over the past week or so. So this is a daily sector rotation model, and this is something we use very heavily when we're looking for specific symbols. So with that, what we're going to do is we're going to do a live symbol analysis together, and we're going to show you how I typically look at some ideas and evaluate a specific symbol and a specific company to gauge a directional view. So as you can see here on the left-hand side, here are the symbols that you have submitted. We have over 3,500 registrants to the event, and you guys collectively have submitted a few thousand symbols. So we simply took the ones that had the highest submissions and ranked them from top to bottom. These were the top 13 that came out of your user submissions. So I'm going to try to go through as many as possible. We'll start off with Enbridge. Enbridge, having had a fairly tough year in terms of really not progressing along with XIU. As you remember, XIU was on a straight path forward. Enbridge has largely been sideways, but recently broke out above this $46 level, coming back to retest this level as support. And if we zoom in here on the daily chart on the right-hand side, this uptrend is starting to look a little weaker. As you can see, this is the bullish uptrend that recently was broken. It's been retested as resistance and has started to fail to the downside. So technically speaking, you have a long-term chart that actually looks fairly constructive, but the daily chart is starting to look a little weaker. So you have slightly conflicting signals between the daily and weekly chart. If you look at the business itself, Enbridge pays a pretty hefty 7% dividend yield. It does have strong operating cash flows that covers the capital expenditure as well as the dividend yield. So this is a stock that is fairly loved by analysts. 7 out of 8 analysts have a strong buy rating here on Enbridge. But you have to remember this is oil and gas. It's a pipeline business in oil and gas. So this is one of the sectors that are not particularly strong. So keep that in mind as you're investing in this specific sector of the market. So when you're looking at potential option opportunities, it really depends on whether you're bullish or bearish on this particular stock. I think if you're bearish and you think that this is breaking this trend line and has the opportunity of moving fairly quickly, buying a put spread is a great way to limit your risk as much as possible to potentially have a strong risk to reward as you get that acceleration to the downside. But with a strong 7% dividend yield, many long-term investors might want to sell a put option here to number one, potentially own this particular stock and then collect that 7% dividend yield. Moving on to Air Canada, the second most requested name. So Air Canada here has some major resistance here around 28 and 31. These are two major resistance levels that I currently see on Air Canada. And Air Canada needs to break out above 28. If it can break above 28, I think it's likely headed to 30, 31 here to the upside. However, this is really where what's concerning for me is the fact that Air Canada is underperforming the JETS ETF, the Global Airlines ETF. So it's falling behind the rest of the global airlines. And if you look at the business itself, last quarter, it lost over almost double the amount of revenue that it generated. It generates $729 million in revenue, but lost $1.3 billion on that $700 million revenue. That's not a particularly strong trend. It struggles to generate free cash flow. Most airlines are just near generating free cash flow at this point. Air Canada is nowhere near there. And but it does have enough cash to meet the short-term operating costs. It does have enough cash to at least to potentially stay around for the next 2 years or so, but may run into some trouble, further down the line. The airline industry is recovering fairly quickly, but this is one that's not recovering as fast as the other airlines. So as an investor in airlines, I certainly think that there are stronger airlines to look at than Air Canada. The next stock is BlackBerry. This was a very widely requested stock, partially, I think, because of the whole GameStop rally that was associated with BlackBerry. The one thing I will say is that whenever you have what is effectively market manipulation that we saw during the GameStop rally, I typically like to I like to remove those parts of the chart when I'm doing analysis. I tend to find that the price action within that time frame is largely useless for investors. So what you have to look at is just the chart without that specific spike. And as you can see, it's on a clear downtrend that recently did break out here to the upside. So that is, in theory, fairly positive for this particular stock. And it is a stock that could potentially generate another GameStop-like rally. And we've seen GameStop continue to rally fairly strongly. We've also seen AMC. BlackBerry could very well see another rally along with those stocks. So for those investors may be interested in trying to participate in something like this. But when you look at the business itself, BlackBerry has had declining quarter-over-quarter revenue, 347 million, 287, 267 million. Those are the past 3 quarters in terms of revenue. You never want to see a stock decline in terms of revenue quarter over quarter, and it's a business that is barely profitable. It's likely going to be profitable next year, but only by so much. And the challenge here is the fact that BlackBerry, their only business right now is cybersecurity, and the cybersecurity space is very crowded, and there are some strong players in that particular space. Whether you're talking about big players like Cisco, or if you want to talk more niche players like CrowdStrike or Fortinet, those are, in my opinion, better opportunities. But for BlackBerry traders, I do think that to try to capture that potential upside, the best way to try to capture that potential upside is to outright buy a out of the money call option or a call spread here. That would allow you to largely take advantage of these particular sharp moves to the upside, but do so in a way with a fairly small amount of risk. But BlackBerry, fairly, I would say, volatile, and the options are going to be very expensive. So be very careful and be cognizant of that when you're buying call options or call spreads on a stock like BlackBerry. Then we'll move on to Manulife. Manulife Financial is interesting because it has this major double top here around $28, 27.5. That is not particularly constructive of a stock when it has such a strong double top and starts to move lower here. But the stock is down about 10% since then, and it does have some potential opportunity if it breaks above the 21-day moving average, which is the orange moving average you see on the right-hand side of the chart. So after pulling back 10% from that double top, if it breaks out above that 21-day moving average, I do think that you're likely going to see a revisit up to that 27.5 level. If it breaks out above 27.5, that's really where you have some major upside advantage. And if you look at the stock, the business, it's a strong business. They have a strong amount of exposure globally to Europe, to Canada, and the Americas, especially in the U.S. And what I particularly like about the stock is that for a financial institution, it trades at a fairly reasonable multiple. Many financial institutions do, but this one is outright inexpensive at 8x earnings. Historically, Manulife has traded about 9 to 10 times earnings, so you're talking about a fair amount of upside here from its historical valuation. And we've seen 10% earnings growth here in 2021. That's a fairly strong earnings growth for a fairly established old financial institution like Manulife, and a fairly boring business, if you will, from the insurance side of things. Wealth management and insurance, relatively boring businesses. But the one thing is that wealth management, as global equities continue to print new all-time highs, that's going to generate more fees for wealth management. So for those reasons, I think there's, it's an interesting business for Manulife. And for this type of name, because it's a relatively slow moving name, selling a put credit spread many times may be the better way to play this, because that allows you to be profitable, even if it just has a slow rise here to the upside. Something like selling a 25-24 put spread that would collect a little premium. Even if Manulife stays where it is and doesn't move significantly higher, you are still profitable in a trade similar to a put spread. Then we'll look at Shopify. I know there's a lot of requests for Shopify. If you look at the chart, very strong uptrend here last year during the pandemic, and then slowed down substantially over the past few months in terms of how this stock has moved sideways. You have largely what I would consider a fairly slow uptrend here for the stock, and it's currently trading near the upper bound of that stock. Now, for me, to look at Shopify, you really have to understand the business, because it does generate significant free cash flow. That is important for an investor. It has extremely strong balance sheet for a player in this particular space. But the one thing that you have to keep an eye out for is the fact that revenues, earnings growth have started to decelerate, and the stock is extremely expensive. It trades at 43 times sales. So a stock like this really needs to keep up their revenue growth. As you can see, they made $2 billion in 2019, $3.73 billion in 2020. That's almost 100% gain. But if you look at the quarterly revenue, last quarter, 1.24 billion, but the quarter before that, 1.25 billion. So you're starting to see this revenue top out, decelerate, and maybe even start to come down a little. And that is very concerning to me for a stock that trades at such rich valuations. So you have to keep an eye out for those valuations to think about whether this is still an investment for you, and evaluate the potential upsides, because I do think that for this stock to continue to rally, it really needs to execute perfectly quarter over quarter, and we're starting to see some of that slow down. The one thing to say about a name like this, especially for a fast-growing company, is that it's extremely profitable. Most other companies that are growing this fast are not doing it profitably. So that is the one, I think, positive for Shopify. But because of the upside risks, the downside risks rather, I think that if to look for opportunities or look for long opportunities in a name like Shopify, you have to use a strategy like a debit spread, like the strategy here on the right-hand side, because you want to minimize the amount of risk you take. First of all, it's in a very expensive stock. So using options is one way to get exposure without having the capital that's required to buy such a significant percentage of the stock. But using options could limit your risk to the downside to just a small percentage of the stock price. Next one is Suncor Energy. Suncor Energy, let me pull up the chart. Whoops. Suncor Energy. So here's the thing about this stock. You have this massive resistance here at this $28, $30 level, which also happens to be a major gap that has not been filled since the pandemic. And from my perspective, there is the potential opportunity for this to break out and fill that gap, but we've had 3 attempts at it and it has not happened. So if it breaks above 29, then I certainly think we'll likely see 33 again. But even if it gets up to 33, my concerns is that once it fills that gap, it will simply just continue the long-term trend, which is clearly to the downside when you're looking at this specific stock. And if you look at the business itself, what I do find interesting is the fact that the quarterly growth in terms of revenue has been extremely strong here this year. It's been accelerating We're expecting about 26% revenue growth here in 2021, substantially stronger than many of its peers. And it is expanding its operating margins right now on this particular stock. As you can see, it made $821 million on the $8.6 billion in revenue last quarter. So this is something that's heading in the right direction from pretty much all the relevant metrics for this particular stock. And the thing here is the fact that Suncor Energy did reduce dividends earlier this year during the pandemic, but it does generate a strong amount of free cash flow that could potentially reinstate its old dividend back to a yield that is comparable to many of its peers, closer to 5 to 7% versus the roughly 3.5% that Suncor Energy currently pays. The next one I want to take a look at is Lightspeed. A lot of people looking at Lightspeed, very similar to Shopify in terms of a business, very similar to Shopify in terms of a stock chart. Big breakout here during the pandemic, but since then has seen mostly sideways price action here to the downside. Now, when you look at the two businesses between Lightspeed and Shopify, very similar in nature in terms of revenue growth. Lightspeed is a significantly smaller player than Shopify. But the one thing I will say is that Lightspeed is still accelerating its quarter-over-quarter revenue versus Shopify has actually seen a bit of a decline here. It is just as expensive as Shopify, trading at about 37 times sales versus about 43 for Shopify. But it loses a substantial amount of money on that revenue growth. So like I said, many of the names that grow at this type of pace are not nowhere near being profitable. Lightspeed certainly falls under that particular category. So that is concerning to me for a stock like this, is that it really needs to continue this revenue growth in order to sustain these valuations, especially because it's not profitable. The next one we'll take a look at here is BCE, the largest telecommunications company in Canada. Now, as far as BCE, what I do like is the fact that it's currently trading up against the $60 relative resistance, if you will. And it looks like it's currently just breaking above this level. And if it can hold the $60 resistance level, it certainly has a fair amount of upside all the way up to about 65 or so. But when you look at the business itself, it's not particularly attractive. If you look at the annual revenue, as you can see, it's pretty much flat. It actually saw a little decline here in 2020. Same thing, quarterly revenue growth, largely flat. It makes a decent amount of money on those on that flat revenue, but whatever gains it has in the wireless business, it pretty much loses on the wireline business. So it's just not a particularly attractive stock other than the dividend yield. And I understand quite a few investors are in this particular stock purely for the dividend yield. So for those reasons, similar to stocks like Enbridge or Manulife, the type of strategy that I think makes sense is simply selling a put option. It collects a fair amount of yield and potentially allows you to own a stock that is going to pay a fair amount of dividends. Same thing for TELUS stock. Now, TELUS stock is a little better looking than BCE. As you can see, it is up against a major all-time high resistance, because if it breaks out above that level, that certainly puts it into a much better category than BCE. And the business also looks substantially stronger than BCE because first, it has strong revenue growth, about 5 to 7% versus BCE has been roughly flat. It pays a 5% dividend yield with a relatively healthy balance sheet on top of that. So when you look at the two businesses, TELUS's revenue growth, I think, clearly makes it a winner against BCE. So for this, especially when you're trading the near all-time highs, the best strategy is to use a call vertical spread. A call vertical spread allows you to take advantage of upside, or you could potentially also use a diagonal spread that gives you exposure to the stock over the long run, but does so in a way with a relatively small amount of limited risk in relation to the underlying stock price. Next, I want to take a look at CNR, Canadian National Railway. When you look at this stock here, what is interesting to me is that this $150 level here is a triple top. And then you have these series of lower lows. This is kind of what we call a megaphone formation, and this could go either way, but it's really far away from the upside here around 149, 150. And if we zoom in here, what is concerning to me is the fact that this stock has been upgraded by quite a few analysts in the past week or so. I think 4 analysts on the street have upgraded this stock to buy in the past week or so. Yet, despite that, it has failed to get back above its previous 2 highs. It is still back below those previous 2 highs. That leads me to believe that there could be further weakness here for Canadian National Railway here. Now, the other thing here for Canadian National Railway is the fact that revenue growth has started to slow down. Both annual and quarterly revenue growth has started to slow down. And you have the energy market, you have the auto market that is starting to slip in terms of capacity for Canadian National Railway to ship those type of goods right now. That is concerning to me. And it's expensive. It trades at 23 times forward earnings versus the historical average for this stock is about 19 times. So it's trading fairly rich to even its own history. And I think for those reasons, I'm not particularly positive on the stock. I think it's more likely that it'll pull back here towards the 129 level here, 128 level, which is the long-term support here. And for those types of strategies, I don't have a strong directional view. I don't believe that this stock is going to move significantly to the downside. So that's why selling a call credit spread that would be fairly neutral or mildly neutral, I think, is the best strategy for a name like Canadian National Railway. CVE, Cenovus Energy. If we look at Cenovus Energy, you have this, you have this break above $9 here, which I do think is fairly constructive. So you have a gap at about $8. It managed to break back above it. It then broke out above $9, and then so far has held that level. And it so far, I think from that perspective, looks fairly constructive. And what's interesting about this particular stock is that ever since it announced the acquisition here for Husky, the stock has been really on a tear from about $7 to about 10.5. And it's really been able to diversify itself from an oil and gas company into oil and gas and refining, about 50-50 split in terms of its revenue between those 2 markets. And investors seem to have really taken on this diversification that Cenovus Energy has taken on and has liked it quite a bit. And the stock trades at a fairly reasonable discount to its historical average in terms of valuation. It's currently trading at about 6 to 7 times enterprise value to EBITDA, which historically it trades closer to about 9 times that. So this is a stock that I do think has a fair amount of upside, and investors clearly are liking the fact that they've recently bought Husky and diversified their business. We have just 2 more symbols before we wrap up. Barrick Gold. Gold has been on a tear lately, and Barrick Gold has certainly been a part of that here. If you look at the stock, this is a stock that has really performed very poorly recently, but has started to rally since gold started to break out here above that. For those of you that follow GLD, breaking above 166 resistance, breaking out above the 200-day moving average recently on gold. Gold is really on its way towards that 183, 184 to the upside on GLD, for those of you that follow the GLD ETF. And the great thing about Barrick Gold, from my perspective, as far as the business goes, is that it trades, again, at a very substantial discount to its peers. It trades at 17 times earnings versus most of its peers trades at 25 times. And it has a stronger balance sheet than pretty much most of its peers. And it gains market share as well. So it's not only is it one of the biggest gold miners, it's continuing to gain its market share, and it trades at a relative valuation. And you have a technical chart that looks strong after breaking out from this downtrend. So the fact that you have all of those things, I do think, in line is constructive both on the technical and fundamental picture. And from an options perspective, I certainly would use a call debit spread here to look for upside, because that allows you to limit your risk as much as possible on this fairly speculative bet that gold will continue to rally, especially as we talked about Bitcoin and digital assets, moving in reverse to the dollar. And the last stock Algonquin. Algonquin, this stock trades not particularly well. Multiple attempts to reach new highs have failed. You really have what looks like almost like a head and shoulders top here, and is starting to test the neckline here. A break below this neckline would certainly bring the stock down into the $13, $14 range here. And this is a stock that's really hated by analysts. But I will say, I want to provide a little devil's advocate here because of how bad the stock is trading and how hated it is by analysts. But when you look at the stock itself, when you look at the business, while the annual revenue growth isn't particularly attractive, the quarterly revenue and income has been on a pretty nice tear this particular year. So this is one that I do think, with the strong net income that it generates, the relatively strong revenue growth that we see, and the fact that it's hated by so many analysts leads me to believe that this is a potential bounce opportunity. Now, this is fairly speculative in nature, which is why I do think buying a call or buying a call spread to limit your risk as much as possible is the best way to play it. And as soon as if it does break below that support level, below 15, that would be your signal to get out of this trade. So with that, that covers my rapid fire session here. I hope that this gives you some insights into how a strategist would evaluate a chart and evaluate the fundamentals in the business of a company to decide whether it's something they want to take a bullish or bearish position on using options. And hopefully this gives you also some ideas as far as how options can be utilized to limit your risk as much as possible, because at the end of the day, you never know where the market's going to go. And it's important that you control your risks when you are wrong. So with that, if you're interested in finding out a little bit more about what we do here at OptionsPlay and learn more about the types of strategies that we put out, you can sign up for a free trial or free access to everything at optionsplay.com/TMX, courtesy of the TMX. All resources that we provide are free of charge. So with that, I'm going to hand this back to Michelle and for closing statements during today's session. I hope that you guys enjoyed this.